Silver, savings, speculation, or a sucker's bet? That's the question that I'm raising today in this video. So I'm going to unpack silver's split personality, why it can outrun gold and blow up your nerves in the process, and how everyday investors can decide whether silver belongs in their safe or their Sharesies or Hatch account or even in their Kiwi saver. Now, if you don't know me, my name is Darcy Ungara. I'm a qualified financial advisor. And for full disclosure, I have been a holder of silver now since 2019 in physical form through ETFs or exchange traded funds, and also more recently through my own Kiwi Saver fund. Now, my goal in this one is not to hype silver, not to pump my own bags, nor is it to bash it. Of course, I'm not going to do that. Instead, I want to give you more of an informed framework for you to decide what role, if any, silver has in your own investment portfolio. Let's get started. Now, in the 1970s precious metals bull market, silver delivered a staggering 3,000 plus percent gain, rocketing from roughly $1.50 per ounce, US dollars, to a peak of just under $50 per ounce in 1980. Now, the price performance of silver totally blitzed gold's impressive but smaller increase over the same period. Now, the current bull market, and I'm pretty sure we are in a bull market for silver right now, and gold for that matter, it tells a different story so far. So, silver bottomed out in 2016 at around $15.50 per ounce. And since then, it's surged to approximately, depending on when this video gets released, between 60 to 65 US dollars per ounce in December of 2025. So, this is roughly about a 290% increase to date. Now, while that is significant, it is far more muted than the 1970s parabolic price move. But in 2025 in particular, we've seen the emergence, or more of the obvious emergence, of the general debasement trade, which includes Bitcoin, gold, and silver. So in 2025 alone, we've seen gains in silver up to 107% year to date. It's finally broken the 2011 high, and it's surpassed the psychologically important $50 level that had it held for 45 years. Now, of course, it goes without saying that I'm talking in nominal dollars here. Adjusted for inflation, we still have a long way to go before we really reach all-time highs. But before we get into the weeds, even more than we already have, there are three things every investor needs to tick off their due diligence list on silver. Firstly, how it behaved in the past bull market. Secondly, how much upside is left in this bull market. And thirdly, how much volatility or extreme price changes that you're honestly willing to wear or bear along the way. Let's start with the first piece of this puzzle, silver's split personality. Because if you don't know what this metal actually is, everything you think about its upside and its risk is built on a very shaky foundation. Silver is both an industrial metal and a monetary metal. And what this means is that part of its demand comes from factories and technology. So think electronics, batteries, solar panels, and even missiles, which have a lot of silver and the nose coin of those bad boys. You don't want to get in the way of that. Silver is very heavy. And there's a whole bunch of modern bits of infrastructure and technology that quietly consumes a lot of silver as an input. Now, on the monetary side, the rest of the demand comes from investors, central banks, and bullion holders using it as a type of sound money that can't be created with a keystroke like fiat currency can, like the New Zealand dollar can. And here's where the split personality comes in. The industrial and the monetary demand aspect creates what some experts call the silver price paradox. When most commodities rise in price, their demand falls. It's economics 101, right? When price rises, demand falls. I like to think of it as milk powder or logs or beef exports, typically the stuff that New Zealand makes money off. If prices spike too much, buyers offshore might start looking for cheaper substitutes or suppliers, or either way, they might cut back their orders. So demand eventually pulls back. But with silver, industrial demand can fall while at the same time, monetary demand can spike. So in India, for example, silver annual imports in 2024 were more than twice the level seen just a couple of years earlier, with much of that jump coming from investors who may like to stay off the books to avoid taxation issues potentially. So silver ends up behaving in this odd way where the same price surge that scares off factories can simultaneously attract more buyers of this form of sound money, pulling the market in two opposite directions at once. So, this silver personality disorder means that silver supply, which is a key ingredient in predicting price, is harder to get a handle on than gold. And added to all this is that most silver comes as a byproduct from copper, lead, zinc, or even gold mining activity. All that to say, supply and demand is very nuanced, to say the least, with silver. And when you line up silver next to gold, the nuance continues. So, in every precious metals bull market over the past 50 years, price seems to follow a pattern. Gold rises first as the fear metal, then silver takes over later on as the greed metal, often once the mainstream retail investor catches on, kind of like what's happening now, is my theory. So, one idea here is that a lot of this comes down to simple unit bias. What that means is that everyday investors like you and me, well, we might feel like we're getting more bang for our buck buying a lower priced metal. And when this rotation into silver happens, which means that money starts shifting out of gold and into silver, well, silver often stops behaving like a sleepy cousin of gold and it starts acting like the leveraged high beta version of the same macro story, meaning it tends to move more violently than gold, not just in the upwards direction, but in the downwards direction too. And I think what we're seeing in the price performance recently suggests that we might be at the early stage of this. And if that's true, we might see silver repeating that historical pattern of outperforming gold by roughly 2 to 1 over this cycle. Now, that's the upside volatility that we all want as silver stackers, but there's an evil cousin, an evil double edged sword to consider here on the other side, even inside what's called a secular bull market, which is basically a long term, multi year uptrend where the big picture is upwards and to the right. That can still contain extremely nasty corrections where the price can drop suddenly between 20 to 50% or even more with no reason whatsoever given. And these sudden pullbacks might feel really catastrophic. And even though the underlying thesis of why you're holding silver is solid, it can shake the silver out of you. It gives you lettuce hands, and you might let go and sell your silver into fear and lock in a loss. And I learned this lesson the hard way myself with Bitcoin initially. High returns are very closely related to high volatility, and the opposite is true as well. The more volatile something is, the more possible it is that you're going to get a high return with it. It's about hanging on, though, throughout the volatility, even if this means hanging on through violent price swings where you feel like you've made a really dumb decision. Again, as long as you've done the research and your thesis is sound, the returns are worth it in the end. They really are your reward for your bravery, for your research, and for your high conviction. Now, just to break this down a little bit more, going back to the 70s, gold went from $35 to $850, right? But right in the middle of that move in 1975, the price fell by half. Now, people who got shaken out, and there must have been quite a few, well, they then missed an eightfold increase in the price of gold over the next 5 years. So keep in mind that silver can be even more volatile than this. Now, if you want to go even deeper on exactly how and why this pattern plays out, I recently had a detailed conversation about silver, uranium, and gold with contrarian investor and precious metals expert Rick Rule. There's a link in the notes to watch that full chat. Now, if that big picture stuff about cycles and volatility, if all that stuff makes sense so far, the next step is to drag it out of theory and start thinking about it relative to your actual portfolio. And as a reminder, this isn't financial advice. I don't know your circumstances. And to be honest, silver has a reputation for ripping the odd face off. So please act with extreme caution here. Do your own research before you take action. But let's bring this down a notch and let's consider the job that potentially you want silver to do for you, or more specifically, your portfolio. Now, there are several ways that you can gain exposure to silver. Firstly, you can buy and hold physical bars and coins. Now, I went through a bit of drama getting my silver coins and a silver bar out of storage here just to show you this. This stuff is super, super heavy. If you want to go into a fist fight holding one of these bad boys, you're going to win. Physical silver is great, but there's a lot to consider. Remember, this is a bearer asset. So whoever holds this holds a form of money that they can use, they can exchange it for other types of value. It's useful in a zombie apocalypse, right? In a prepper sort of way. But it's also a really good way, in my view, to properly diversify away something called custody risk. Custody risk is one of those things that we're all taking when we're investing into exchange traded funds or shares that are owned on investment platforms or even traditional managed funds in KiwiSaver. Our investments are held separate from the investment service provider on our behalf to remove the risk that that provider fails. But at the same time, we're still exposed to a systemic risk where that custodian, the holder of that investment on our behalf, could potentially fail. Extremely unlikely, but it's not impossible. So when you own the physical, you're just that much more protected, or at the very least diversified from that type of custodial risk. Now, ETFs, or exchange traded funds, especially those that hold the actual physical silver on your behalf, it avoids the extra costs associated with paying a service provider to hold that physical silver on your behalf, like I do, or it removes the risk of holding that silver in a safe or the risk of you forgetting where you bury it in the garden. Yes, you still have to pay a fee for these exchange traded funds, but they're usually quite reasonable. And I personally will have some of my silver exposure and gold exposure on ETFs. I personally use Hatch to do this. And there is a link in the show notes if you want to sign up to Hatch or Sharesies. And these are both platforms that allow you to access all sorts of ETFs that hold a wide variety of shares or other types of commodities, precious metals, and even Bitcoin. Now, the next way that you can hold your silver is through KiwiSaver. Now, for full disclosure, I am a financial advisor and I do help people build investment portfolios and bespoke KiwiSaver portfolios from scratch. And that includes including specific things upon request like silver. And if that's of interest, again, there's a link to reach out to me in the notes where you can learn more about how that works. But before you buy silver, though, whether it's physical, ETFs, or through KiwiSaver, you need to decide, is this a saving strategy to protect you from long-term harm caused by currency debasement, often marketed as inflation, or is it speculation? Are you trying to ride to the top and then make a quick exit? Or, let's be honest, is this just a little bit of noise? Is it of interest, but is it something that maybe you're best to avoid? Be honest with yourself. It's really important to understand, again, what that job is that you're employing silver to do. If it is savings, though, a very small allocation to physical silver might be something for you to learn more about. And I stress that word physical because, yes, it's more of a hassle buying, storing, and ultimately selling physical silver, but you're going to be less tempted to overtrade it. And therefore, you're less at risk of losing money from buying out of emotion at a high point and selling out of emotion at a low point. Now, if it's speculation, you may want to consider even smaller amounts and accept the volatility here may ultimately result in a loss. But hey, if you make a gain, well done. But remember, many braver and many smarter people have ventured into the silver speculating space with leverage using things like CFDs or contracts for difference. They've done it and they've often had limited success. And I'm one of those examples. So set some rules and boundaries with any trading accounts. Beware of your tax obligations and understand all the rules of the platform that you're using, especially if you're using leverage. You've been warned. But lastly, if you are honestly just interested in a good old story, then no problem. Silver offers a great story to tell. And it's not a game that you need to play. but it is a great way to learn more about how markets work, but more importantly, I think, what money really is. So, is silver the right move for you? Well, honestly, all I can say from my experience is that right next to property, right next to tech stocks and Bitcoin, once you learn how to convert the volatility of silver into a feature that you can manage rather than a bug that blows up in your face, it can be a great way, I found, to take a little and turn it into a lot. More importantly, it can teach you how to handle uncertainty in markets, which is really what you need to master if you're in pursuit of something greater than average. Now, I hope you enjoyed that one. And if you did, please like and subscribe. Let me know what you think as well. Is silver something that you have a view on? Would it be something that you would hold? I'd love to know. Until then, we'll catch you in the next one.